problem solving session number 3. This session is based on problem set number 3 in the accounting class that we are taking. And I have selected 5 questions from problem set number 3. Now remember, in every problem set, any question with a T in front of it is a former test question and is a likely question for what you may see sometime in the near future, say on an exam. So in this particular session, the 5 questions, question 8, which is a question about treasury stock, question 11, a question about bonds, in this case at a discount, question 12, an asset retirement, question 15, depreciation, kind of a question. This is more of a theory question on why or how to choose the right particular type of depreciation for any company you might be with. And the last one, which we're going to do fairly briefly, because we will go through bonds in agonizing detail in 11, but on 16 we will redo bonds again the second time at a premium. Okay, question 8, treasury stock. Here we go. So in problem set number 3, your question number 8, the information looks like so. This particular company is buying back its own shares of stock. And so this company has 5,000 shares of $10 par common stock outstanding. These shares were originally issued at $25 a share, which frankly isn't that important, except for you need to know what the par value was, and we'll show why that's necessary in a second. They reacquire, they go out and purchase 2,500 shares at a price of $24 per share. So the first thing is they go back out and buy their own shares of stock. Second step is, of the 2,500 they purchased, they sell 1,250 at a price of $26. Third step, and the third entry we're going to make, is they now sell 750 shares, and they sell them at $21 per share. And so our mission, should we choose to accept it, is to journalize these transactions. Now notice down here, originally 40,000 shares were authorized, and there is positive retained earnings of $100,000. Okay, so what's our job? Our job is very simple. Our job is to create 3 journal entries. One for the reacquisition of 2,500, one for the sale of 1,250, and a third one for the sale of 750. Okay, here we go. Journal entry number 1. We acquire 2,500 at $24 per share. So, if we are acquiring these things, what are we giving up? And we're giving up cash. So the entry then is, we recognize the fact that we are buying treasury stock. We are buying back treasury stock. And what are we giving up? We're reducing an asset called cash. For how much? And the answer is, well, there are 2,500 shares times $24 per share. We multiply that out, and that comes out to $60,000. Now here's the tricky part, and that is, what type of an account is treasury stock? Now usually when we purchase something, we would call that an asset. For instance, if we had purchased the stock of GM or Motorola or Microsoft, we would be recognizing an increase in an asset account. However, when we buy back our own stock, that is not considered an asset. We are simply debiting or reducing an equity account. Now the treasury stock account can be perceived or viewed as if it were a contra account. It's an equity account. The equity accounts generally have, the equity accounts on the balance sheet generally have credit balances, but this would obviously have a debit balance, particularly right now. So that's journal entry number 1. Journal entry number 2 is when we sell 2,500 shares. Now, when we sell 1,250 shares, when we sell that, what are we going to get? We're going to receive an asset called cash. How much cash are we going to get? We're going to get 1,250 shares times the price, $24, And so the amount of cash we're going to receive is $32,500. Now, what are we giving up? We're selling that treasury stock. And so the treasury stock that we debited initially, now we credit that account. We're increasing an equity account when we credit it. Treasury stock. For how much? Well, what did we buy these at? The way we account for treasury stock transactions in general is we account for them as if they were a FIFO inventory question. So we value the treasury stock at the cost to acquire. In this case, $24. So the treasury stock will be valued at $12.50, the number of shares, times $24 per share. That turns out to be $30,000. Now, we have a debit for $32.50, we have a credit for $3,000, so we need another credit for $2,500. What is that? And the answer is, well, first of all, what kind of an account is it? We are increasing an equity account. Does this account have any impact on the income statement? And the answer is, it does not. Right? It is not a gain, and that's critical to understand. This is not recognized as a gain. We simply put an account on the books called paid-in capital. Now, you've seen paid-in capital before. This would be a separate paid-in capital account specific to the sales of treasury stock. So it would be paid-in capital dash treasury stock. In this case, $2,500 would be the amount that's in that account. Now, Eleanor, if you take me and move me up to the top of the page so I can use the bottom of the page. I don't know if you can get me to do that, but I'm going to be using the bottom of the page here shortly. Now, the third question, the third entry is where we sell 750 shares. So when we sell, what are we getting? We're getting cash. How much cash are we getting? We're getting the 750 shares times the price we sold. There I am. Times the price we sold at, which was, in the second case, $21 per share. Now, that turns out to be $15,750. And again, we credit or we increase an equity account for treasury stock that we purchased for the 750 shares. But we do that at the price that we originally acquired them at, which is $24 per share. So when we do that, that is $18,000. Notice we have a debit and a credit. The credit is higher, right? So we need another debit. So I'm going to put another debit in here. I'm going to put it below. And so the question becomes, what is the debit in this case? And the answer is, well, we sold this trade. We originally bought it at 24. We then sold it at 21. So you might be thinking, well, oh, we sold that at a loss. Not true. This loss, even though in a sense it's a loss because we sold it at less than we purchased it at, it's not a loss for income statement purposes. However, what we do is we pull the account out of our paid-in capital. So what we would do is we would debit this account right here, paid-in capital treasury stock. So we would reduce an equity account, paid-in capital dash treasury stock, for, in this case, what we need to make this balance. And what we need is $2,250. Now, what would happen if the difference, if this number were much larger, is we would zero out the paid-in capital from treasury stock, and then any excess of $2,500 would then be a reduction in retained earnings. Again, it doesn't affect this particular question, but that is the actual process. So first thing, we zero out any paid-in capital from sales of any other treasury stock, and then anything left over in the event that we sell at a quote-unquote loss would be a debit or would reduce retained earnings. So much for question number one. Question number two, which probably is the most difficult concept. That's why we have two of these kinds of questions. So the second question, back to our roadmap, we did treasury stock. Next question, bonds at a discount. So the next question is how to account for bonds. And we use the effective interest method when we account for bonds. Question 11. Jefferson Corp. Jefferson Corp. sells 100 bonds on 1/1/87 when the market rate of interest was 10%. The bonds had a coupon rate of 8%. So now what happened here? They have a coupon rate of 8%, and the coupon rate was set equal to the market rate at the time they were setting it up, but subsequent to that, the rate in the market increased from 8% up to 10%. Now, when the rate of interest goes up, the present value of the bond goes down. Hence, this is a bond at a discount. Now, the bonds have a face value of $1,000, which is true virtually always and everywhere. And the bonds have annual interest payments and mature in 10 years. All information we will need. Now, generally speaking, in real life, bonds have semi-annual interest payments. But we use annual in this particular example just to make it slightly easier in terms of the arithmetic. All right, question number 1. Journalize the issuance of the bond. In other words, how much cash did they get when they sold it? Second question. Journalize the second interest payment. Be sure to include the amortization of discount premium using the effective interest method. And 3, on 1/1/92, which is 5 years after they originally sold it, the company retires the bonds by buying them on the open market. And at that time, the market interest rate was 6%. What entry did they make when they retired the bonds? So we have 3 questions to address. First, journalize the issuance of the bond. In order to do that, we need to know what the price was. In order to know what the price was, we need to do a present value calculation. So the value of a bond, what does a bond look like? Go into the pad. The price of a bond is equal to the present value of the cash flows. So the economics is that price is equal to the present value of the cash flows. And in this case, the bond has, or in this and virtually all situations, the bond has 2 components. It has a coupon payment, which is the second line right here, and it has a principal amount. Now the principal amount at the end is how much? $1,000. And the coupon payment is based on the coupon rate. In this case, the coupon rate is 8% times the face value of $1,000. Face value is the amount that the bond will pay at the end. Gives us a coupon payment annually per year of $80. Now, how many periods? From period 1 through period 10. So it's $80 per period is what the buyer's bond will get for 10 periods, and then at the end of the 10th period, they will also get $1,000. And so the question is, what's the present value of that cash flow at the current market rate of return? And the market rate of return, the coupon rate was 8%, but the market rate, right now, the rate in the market has increased from what it was a couple weeks ago, 8%, up to a current high of 10%. And as we said before, when the interest rate goes up, the price of the bond goes down. And hopefully it's intuitive that that would be very bad for the company that is selling the bond. Because in essence, all that has happened is that the rate at which they are borrowing has increased from 8% up to 10%. And an increase in interest rates when you're borrowing, clearly not a good thing. So, back to the price. We do this present value. What does it look like? The present value, the top part of $1,000 for 10 periods at the market rate of 10%, plus the present value of the bottom part, which is the present value of an annuity of how much? $80 for 10 periods, and always at the same interest rate. Now, when we do that calculation, what we find is what? That the bond has a value of $877.11. Give or take a penny. Now, the company is selling how many bonds? It's selling 100 bonds. So the entry when these bonds are sold, the company is going to be receiving what? It's just basically the company is borrowing money. So the company is going to be increasing an asset called cash. For how much? It's going to be $877.11 per bond times 100 bonds, or a total of $87,711. $87,711. Now, how much do they owe at the end of the period? And the answer is, well, at the end of the period, in this case 10 years is the period, bonds payable is going to be 10 bonds at $1,000, or $100,000. Now, what that then suggests is that we need another debit in here. And so the rest of this entry, to put the debits together, we are going to need to debit something. And how much is this debit? It's going to be $12,289. So let's put in what we know. The debit is $12,289 because the debits have to be equal to the credits. And what is this going to be called? And the answer is going to be called discount on bonds payable. Now, what type of an account is discount on bonds payable? And the answer is discount on bonds payable is a contra liability account. Now, liabilities generally have a credit balance. This contra account, therefore, has a debit balance. So it's a reduction in a liability account, and it's a contra account to the bonds payable account. And therefore, this entry is the answer to question number 1. Journalize the issuance of the bond. Next, the question is, journalize or create a journal entry for the second interest payment, and be sure to use the effective interest method. Okay, here we go. The first thing I'm going to do is I'm going to create T accounts for what we just did. The T account, bonds payable, and the discount on bonds payable. And I want you to understand that you can think of that as bonds payable net, because that's in effect what we're going to be doing. So the bonds payable in total were how much? This is a liability type account. 10 bonds at 100 bonds at $1,000 a piece, $100,000. The discount was how much? $12,289. Now these things, if we net them against each other, bonds payable net is how much? It's the amount of cash that came in the door, $87,711. Now, it comes time for the first interest payment. And the first interest payment is going to be what? How much cash goes out the door? And the answer is, well, we go back to our initial picture. The amount of cash that goes out the door is the $80. However, the $80 was contingent upon an interest rate of 8%. And in this case, the interest rate rose up to 10%. Hence, the amount of interest expense will be greater than $80 in this particular period. Well, let's see how that works. So the company is recognizing interest expense, and so they are going to reduce an equity account called interest expense. And what is interest expense in the first period? Interest expense is going to be the amount they're paying. Now, how much are they paying? Because of the discount, they're paying the market rate, which is 10%. So it's going to be 10% times the amount they borrowed, in this case, the amount up here, 87,711. So the interest expense in the first period is going to be $8,771, give or take a few pennies. Now, how much cash is going to go out the door? And the answer is, well, the amount of cash that they're going to pay, if we go back to the picture, they're going to pay $80. Hence, the amount of cash, reduce an asset here, cash, for $80. 80 times 100, 8,000. And that leaves us with a new account that we need to think about here. 771 is the amount for something. And what would that be? What we are doing is we are amortizing this discount. So this discount has a debit balance. Here we are going to credit or increase a liability account, discount on bonds payable, to the tune of 771. And that is the entry. Now, is that the answer? And the answer is no. The question's asking for the second payment. This is the first payment that we just did. So we need to go through a similar process to get to the second payment. For the second payment, we need to figure out, well, what is bonds payable net at the beginning of the second year? So we take this information and we adjust our T accounts. We credit this account for 771, and to get a new balance here, 12289 less 771 gives us 11,518. So the new balance is 11,518. So we are increasing this amount by 771. 87 plus 771 gives us a new balance of 88482. Let me just check that out. 2, 8, 14, and 1, 8. Okay, that makes sense. Now, in the second period, they're going to recognize interest expense. So this is entry number 1, the first period. Entry number 2 in the second period, they're going to reduce an equity account, interest expense, and how much? 10% times the new outstanding balance, which was 87,811. Now it's 88,482. So 88,482, 10% of that is 8848. So here, 8848, the amount of cash going out the door is 8,000. Hence, the amortization of the discount for the second period, which is an increase in the liability account, discount on bonds payable, is 848. And that, in fact, is the answer to the second question, which is the entry you would use for the amortization in the second period, or in this case, the second year. Question number 3. Question number 3 is, suppose the company retires these bonds. If the company retires these bonds, what entry will the company make? Well, the first thing you need to understand is how to get the value for the bond on the books of the company. The second thing is, how do we get the value of the bond in the market? So, let's take the first question. What we just did, if we come back to this example, was we went through 2 periods. The initial balance of the bond, 87,711. The balance on the books of the company, 88,482 in the second year. And then at the beginning of the second year it was 88, and then we adjusted again by 482. We could get the balance at the end of the second year, and so we could continue on with that calculation. However, and that's very easy to do if you use something like Excel or something like that. However, what I would suggest doing is think about this in terms of present value. And what's going on is that the amount on the books of the company is going to always be equal to the present value of the future cash flows at the original market rate of return. So in this case, the value of the asset on the books of the company is going to be equal to the present value of the $1,000 over the remaining life. Now, what's remaining? And the answer is, well, it was initially issued on January 1st, 87, so it's 87, 88, 89, 90, 91, and we are retiring it on January 1st, 92. So there was 5 years gone by, but more importantly, there are 5 years to go. So if we take the present value of the future years to go, which in this case is 5, so it's the present value of $1,000 for 5 periods at the original interest rate in the market, 10%, plus the present value of the annuity of $80 for 5 periods at 10%. And when you do that calculation, what you find is that the net book value of the bond on the books of the company is $924.18 times 100 bonds is $92,418. Now, what is the value of the bond in the market? And again, the value of anything in the market is the present value of the future cash flow. In this case, it's the present value of the future amount, the $1,000, for 5 periods at what interest rate? And the answer is at the interest rate in the market. And the interest rate in the market is 6%. Plus the present value of the annuity of $80 for 5 periods at the rate in the market, 6%. When we do that calculation, now, as the interest rate went down, the price of the bond goes up. There's an inverse relationship between rate of return and price. Hence, the price of one bond would be $1,084.25, which multiplied by 100 is $108,425. Now, keep in mind that the original amount, this is the net book value. So in terms of the picture, the $92,418 is equal to bond payable net at the end of 5 years. However, on the books of the company, they have bonds payable and discount. So we need to figure out what would the discount be. And the discount would be $100,000 less $92,418. So here we go. When the company retires this bond, the entry they would make, first of all, put down what we know. What we know is that we are going to take the bond off the books. We're going to reduce a liability account called bonds payable. And the bonds payable account is the amount in this original key account right here for $100,000. So we're going to debit bonds payable for $100,000. I'm going to leave some space. I am going to recognize that the amount of cash they're paying to buy this thing is they're buying it at the market rate. So the amount of cash that's going out the door, right, reduce an asset account cash, is $108,425. Now, in addition, we have to recognize, we have to pull the amount of the discount off the books, and $100,000 less $92,418 is equal to $7,582. So what's going on, going back to this thing right here, currently the discount account has a debit balance of $7,582, and it would be similarly attained as we did right there. So in order to get that off, it has a debit balance. To get it off, we credit it. So we credit the allowance account, we credit the discount account, we increase the liability, discount on bonds payable, for the amount in that account, which is the difference between $100,000 and that, which is again 7,582. But now all of a sudden we have, almost 116,000 in, or we do have 116,000 in credits, 100,000 in debits. We need a debit for how much? Well, to make this thing balance, 16,007. And what will that 16,000 be? Well, what's going on in this case is they have a liability on the books net at $92,418. They are paying $108,000 to get rid of it. That would be a loss because they're paying more than the liability is on their books. And so this would be considered a decrease in equity account loss on the retirement of bonds. So the entry then to retire that bonds would be to purge the original amount of bonds payable, recognize the amount of cash from the market value calculation up here, figure out what the discount would be based on the net book value of the bond, and then back into, the last thing you do is back into the gain or the loss. Now hopefully it makes sense that if you pay more than the liability, right, if you pay, in this case 108, if the amount you pay is greater than the liability, that will be a loss. If you pay less than the liability, that amount would be a gain, and then it would be reflected in the journal entry for the retirement of the bond. Pretty long question, and a very good practice of both accounting ideas and present values. And I've said it many times in the past, present values affects what we are doing in accounting virtually every day. Hence, having a good understanding of present values is key to understanding both accounting and finance. So much for question number 11. Back to our roadmap. So at this point, we've done treasury stock, we've done the discount bond, and asset retirement comes next. And the asset retirement should be a little quicker, depreciation a little bit quicker as well. And we are going to sketch out bonds at a premium. We're not going to do the whole thing like we did for the initial bonds. For the sake of brevity, we're going to show you how to do it, but not go through the last bond question in quite the agonizing detail. Okay, next question, asset retirement, question 12. Question 12. Charlie Brown acquires a machine on January 1st for $120,000. It's estimated to last 8 years. On January 1st, 1993, 1 year later, it is determined the machine will not be useful beyond the end of 1993 and that there will be no scrap value. Accumulated depreciation on the machine is calculated using straight line method. Calculate depreciation expense for 1993. Now, the key thing to understand here is that you are basically writing off the balance of the asset during 1993. So you paid $120 for it up front. You are going to then record the loss in the next year. So in essence, what's going on here is, and this is a fairly simple question, depreciation expense for 1992 would be what? So fairly simple stuff here. The 120 divided by the 8-year life gives us $15,000 per year, which is depreciation expense. Now, the net book value at the end of, so for 1992 there'd be 15, for 1993 there would be 15. So what would happen here in accumulated depreciation, we have the 15,000 plus 15,000 or 30,000. So the net book value at the end of the year would be how much? Would be the original amount, 120, minus the 30, or 90,000 total at the end of the year. And that 90,000 would then be written off. So the net amount of expense, or the net amount of depreciation expense that you would then recognize for 1993 is the 15,000 plus the net balance of 90,000, or a total of 105. So the total amount of depreciation expense, or the total amount of the decrease in the equity, would be a total of 105. Again, fairly simple question, but sometimes people don't understand how these things are written up. So much for question 12. Question 15, back to our roadmap. Question 15, depreciation, in this case, the tax ramifications of which method should you use. Okay, question 15. So the company buys a machine for $200,000. The machine is expected to have a 4-year life, but it happens to fit into the 3-year makers category. So the asset is estimated to have a salvage value of $10,000. The company is trying to decide how to depreciate the asset. The options are to use 3-year makers or use straight line depreciation. They intend to use the same depreciation method for tax and book purposes. Now, the way to think about this is, first, show, and so the question is, show which one of these methods will maximize the value of the firm. And the key here is to think about it in terms of a present value of the future cash flow. Now, from a cash flow perspective, which method would you prefer to use? Straight line or makers? And in order to understand that, what you need to think about is the way makers works, and maker stands for what? Modified accelerated, MA, Modified Accelerated Cost Recovery System, MACRS. Now, the way makers works for an asset, and this is makers, so I'll write it right here. For a 3-year asset, is depreciated actually over 4 years. In year 1, and this is included in the notes, which is why it's not included in this particular question. If this were a test question, I would be giving you the maker's schedule. I do not expect you to memorize all the various depreciation schedules for the maker's accounts. But in any case, year 1 is 33.33%. Year 2 is 44.45%. Year 3 is 14.81%. And year 4 is the balance, whatever we get to bring it to 107.41%. And this would be the percentages of the initial asset value that we would use for maker's depreciation. Now, so what we would then do is we then take these numbers and multiply it times the value of our asset. And if we were to do that, what we would find is that for the makers, the asset in period 1 would have a depreciation of, so for makers, I'll bring that here, and for the straight line, I'll do that here. For makers, it would be $66,700 $660, doing some rounding, in the first year, which was 33% of $200,000. $88,900 in the second year. $29,620 in the third year, and $14,820 in the third year. Now, if we use straight line, we would take the asset value, which is original cost of 200, subtract out the salvage value of 10, and have a depreciable base of 90. Divide that by 4 years using straight line, and that comes out to be $47,500. The tricky part being what? Makers, you do not include the salvage value. For straight line, you would include the salvage value. Now, which of these methods should you use? And the answer is, if you're trying to maximize cash flow, you want to take the highest amount of depreciation as early as possible. But from a present value perspective, you would take the present value of this cash flow stream at 18%, and the present value of this cash flow stream at 18%, and whichever cash flow stream, or in this case, the write-off stream, whichever was higher, and in this case, the present value is 146,011, and in this case, the present value is 127,778. So the present value of the expenses for makers is 146,000. The present value of the straight line is 127. Hence, the way we would maximize our cash flow would be to take the higher present value of the expenses. In other words, we want to take tax deductions as large as we can, as soon as we can. And that's what will benefit our company from a cash flow perspective. Hence, we would want to use makers if our goal was to maximize the cash flow of the firm. And I hope that's intuitive, right? Because the present value of the expenses, whichever is higher, means that the present value of the tax deductions, and therefore we're paying less cash to the government early on, getting to conserve or keep our cash, making us better off. We then reinvest all that cash to earn a return. So much for question number 15. Last question. And the last question is another bond question. And we want to make sure that we understand the process, yet at the same time, we don't want to spend a whole lot of time on this particular question. In this case, it's a bond at a premium. And the question, T16. Here we go. So in this case, we have 1,000 bonds. The market rate was 9%, and the bonds have a coupon rate of 10%. Face value, $1,000, maturity 10 years. So that here the key thing is to recognize that when they set the coupon rate, they set the coupon rate at approximately what the market rate was. But what happened here is the interest rate went down. They thought they were going to have to pay 10% to borrow the money. But when the rate of the market went down, that means that the price of the bond, again, an inverse relationship, the price of the bond or the present value of the cash flows went up. Hence, in this case, they are going to get a amount of cash in excess of the face value or in excess of $1,000. So, entry number 1, journalize the issuance of the bond. Entry number 2, the second interest payment. Entry number 3, the company retires the bonds. Typical Boylan question on exams. Those three aspects of a bond, because it forces you to understand present values and accounting. Okay, here we go. So we calculate the price of this bond. What does the price look like? The price is going to be the present value of the face value, $1,000, for 10 periods at the interest rate, which in this case is the market interest rate, which is 9%. Plus the present value of the coupon payment. And the coupon payment is what? The coupon rate is 10% times $1,000. Gives us a $100 coupon payment. So the present value of an annuity of 100 for 10 periods at 9%. Now, when we work through that, which I have done, we get approximately 1064, give or take a few pennies. Now, multiply that times 1,000, and we get 1,064,000. So our entry then, the amount of cash that's coming in the door, recognizing an increase in asset cash for how much? 1064 times 1,000. 1,064,000. And we're recognizing a bond payable. Recognize a liability, bonds payable for how much? 1,000 bonds times $1,000 per bond, or what is that? 1 million. And that leaves us with we need a credit. And the credit is what? An increase in another liability, and this thing is called premium, P-R-E-M-I-U-M, and the premium will be whatever we need to make this thing balance, 64,000. And again, there's some rounding there, but you get the basic idea. Second question, the second interest payment. Now, the second interest payment is, again, going to be based on the amount they actually borrowed and the rate they actually borrowed. So they borrowed 1,064 or 1,064,000 at a rate of 9%. So we go to the second question, and the second question we are asking, what is the entry? And they are going to recognize a reduction in an equity account, interest expense, for how much? Well, the interest expense is the 9%, the rate at which they borrowed, times the amount they got, 1064. Again, and they sold 1,000 of them. So we do that multiplication, and we get that the 9%, I don't happen to have that number, 1064, enter 0.09 times 95,760. So 95,760. And how much cash is going out the door? Well, the amount of cash going out the door is an asset, cash, for how much? $100. We go back. The coupon payments are $100, right? Times 1,000 of them, or $100,000. So the first interest payment has interest expense less than the amount of cash going out the door, and the difference then is 4,240. Now, what is that account? That account is, we are reducing a liability account called premium. Premium on bonds payable. In the second period, a very similar situation. We are reducing an equity account, interest expense, and now it's for how much? Well, it's going to be 9%, and the key thing here is that the interest rate on the books of the company is going to always be the same, which was the market rate when the bonds were sold. 9% times the net book value of the bond. What's the net book value of the bond? The net book value of the bond is going to be 1064,000 less 4,240. When we do that calculation, what we get is that the interest expense is going to be, oh dear, let's calculate that out. 9%, 106400, enter 4240. 0.09 times 95,378. 95378. And therefore, the amount of cash is going to be the same. Reduce an asset cash for 100,000. And then the discount will be the difference. 4622. So that would be then a reduction in the liability, debit the liability premium for 4622. So much for this second question on this bond. Last question. The last question for this particular bond question is, now they retire the bonds. And in this case, again, it's going to be a 5-year time horizon. Because we go back to the original question, it was the bonds were sold on 1/1/87. We are now going to buy them back on 1/1/92. And so to get the present value of the bond, it's the present value of the future cash flows on the books of the company. What does that look like? It is the present value of the $1,000 for the additional period, right, from 92 till the end, 97, which is 5 periods at the original interest rate, which is 9%, plus the present value of the annuity of $100 for 5 periods at, 9%. My brain's not connected to my hand all of a sudden. And when we do that, we get a price of what? Well, approximately 1040. And remember, we're multiplying that times 1,000 bonds in the end. And so this would be the value on the books of the company. Now, the market value of this bond, go back to the question, the market value of this bond is, the interest rate in the market is 11%. Remember, on our books, it was sold at 9%. So we calculate the value of the bond in the market. This is on our books. This is the book value. This is the market value of the bond, coming up here, which is the present value of the $1,000 for 5 periods at 9%, plus the present value of the annuity of the $100 interest payment, the coupon payment, for 5 periods at, this is 11%. The current market rate is 11%. When the interest rate, relative to this one, when the interest rate goes up, price of the bond goes down. And that's roughly 963, again, times the 1,000 bonds. So we go to make our entry, and what are we doing? We're pulling off bonds payable. So we are reducing a liability account. We go back to our first, right? We put the bond payable on the books initially at $1 million. We have to pull that off the books. So we reduce the liability, bonds payable $1 million. In addition, we have a premium on the books, and the premium is roughly $40, the excess over 1,000 times 1,000, 40 times 1,000 is 40,000. So we are going to reduce the liability premium for 40,000. The amount we're paying for this bond, right, which is the reduction in an asset cash, is 1,000 times 963, which is 963,000. Hence, what do we need to make this thing balance? And the answer is, what we need is a credit right here, and the amount we need to make this thing balance is roughly 77,000. So 77,000 is the credit. What is that 77,000? That 77,000 is a credit, an increase in an equity account called gain. gain on the retirement of the bonds. Now, does that make sense? And the answer is, hopefully, you realize that the bond, the net book value of the bond on the books of the company was $1,040,000. They paid it off for $963,000. Hence, the liability of over $1 million got paid off for less than $1 million. That means the company is better off. That would be a gain to this company. And that is our answer. Right? Go back to this for a second. Go back to the... So the entry to retire the bond would be debit bond payable 1,000, premium for 40, recognize a gain for 77, and the amount of cash going out the door 963. So the company makes a gain on this particular transaction. Okay, that is the end of the last question and the end of problem-solving session number 3. Thank you very much.